Hey guys, welcome back to the channel. As we thought inflation was just about to peak last month, today we got a massive reality check. Inflation came in at 8.6%, which beats the CPI report that we got back in March of 8.5%. So a lot of the arguments of inflation inflecting in the summer are starting to look a little bit dull. Now, the reason I don't think this is that big of a surprise is because oil prices have already gone up significantly over the past month or so. And in this video, I want to kind of give you guys a bear case and a bull case of how this CPI report could affect our own stocks. Because obviously, the stock market today on Friday, as you can see, is getting absolutely destroyed. Now, we've had a good couple of weeks in the market, so it's no surprise that if we get a bad inflation report, that stocks are going to sell off, because I've said this countless times, the number one catalyst that is going to make our favorite stocks go up, it's going to be inflation, because that's what the Fed is fighting against right now. But again, before we get into it, guys, make sure to drop me a thumbs up, hit that subscribe button if you haven't already. So the first thing I want to cover is the fact that inflation looks very bad in the short term, but it's important to keep in mind that historically, inflation has always come down as fast as it has gone up. Now, the reason why inflation surged over the past month is not as bad as it really looks. Now, 8.6% beat the analyst estimates of 8.2%, which is obviously very bad. But most of this was happened due to oil, service, and food prices. Now, you guys might be saying those are probably the most consumer focused forms of inflation, right? As consumers, we get affected when gas prices go up and obviously when food prices go up. And that is true. But the reality is that the Fed mostly cares about core inflation, which is something called core PCE. Core PCE sounds just like it is. It is essentially when you subtract oil, gas, and food prices from the mix. And the reason why that's done is because those commodities are very volatile and they can come back down just as fast as they went up because of, essentially factors that are out of the Fed's control. What the Fed can really control is the demand for goods, not services. They can control interest rates and they can control the money supply. And that's going to affect the demand for goods, which is obviously the biggest component of inflation. And that's why core PCE and CPI are so important. And the good thing is that compared to analyst estimates, this core inflation data didn't actually go up as much as the headline number of overall CPI. So this shows us that although oil prices are still going high and that's going to hurt consumers in the short term, regular inflation, what the Fed looks at, is not going up as fast. So potentially the market reaction that we're seeing today could be a little bit oversold to the downside. And as a result, I've personally been continuing to nibble on a little bit of shares in the morning because I'm seeing some nice deals in some of my favorite stocks. And generally speaking, it's a great time to buy when there's a lot of fear, especially when the SPY or the S&P 500 has tanked by like 6% in the past 2 trading days, which is very significant, right? And it's very rare to see deals like this happen within a span of a week or so. Obviously, this is a bear market, so volatility is high. But again, it's important to keep in mind that buy the fear, sell the greed. It's always during times of fear that we make most of our wealth. You realize the wealth a year or two down the road when your stocks have appreciated, but the wealth is built during these crashes. Even though in the short term it's very painful. But again, pain is what you need to endure as an investor to be able to make money. If you don't endure pain in the stock market, you're doing probably something wrong. And that's what we saw in 2020, right? In 2021, you could have bought any stock and it went up to the moon. So nobody really endured real pain or real correction. But as we've seen countless times in the past, especially in March of 2020, we saw a massive crash. Most people ran out of the market. Nobody wanted to invest. But the people that made money were the ones that actually bought during these massive collapses to the downside. And as you can see, that's kind of what we're seeing right now, at least on the S&P 500 as well. This doesn't mean we're at the bottom. Absolutely not, because nobody can predict what the bottom is going to be. But it does mean you want to take advantage of deals when you see them. Obviously, make sure to manage your cash position simultaneously. But the reason why I am continuing to buy is not because only I'm seeing good deals, but also because the macroeconomic situation is still very, very bullish, potentially for 2023 and 2024. And so, what I want to talk about right now is why the stocks that I own in my portfolio, like Nikola, Plug Power, STEM, could potentially do better than most people expect. And a lot of the indiscriminate selling we're seeing in these stocks today could be very regretful for those people that are selling right now. And the reason why that is the case is because interest rates tend to affect consumers the most, right? Credit card rates go up, right? That's what causes people to either sell their home or reduce their spending significantly, and that obviously reduces their overall wealth as well. And so what the stock market right now is trying to price in is the fact that all these consumer focused companies on the market like Walmart and Target are going to see their growth significantly slow down. But the key thing people don't realize is that not every consumer or not every stock on the market is consumer faced. A lot of companies sell to other businesses. This is what we call a B2B business. And in my personal portfolio, at least, I have 99% exposure to B2B businesses. Nikola, they sell to fleets. Plug Power, they sell to other customers and commercial businesses, right? They're not selling to consumers like you and I. And so that gives those kinds of companies an edge over the consumer-faced stocks because they're going to be less affected by higher interest rates. And the main reason that's going to affect, these B2B stocks in the form of interest rates is going to be obviously if they have a lot of debt. But the good thing is, at least for my stocks, I've made sure that the debt levels for the companies are relatively low compared to their cash positions. And I think over the next potentially 24 months, as growth becomes more scarce, right? Because obviously that's what the stock market's trying to price in right now. We could start seeing rotation back into those growth stocks. Even if they're unprofitable, investors are going to look for growth, right? Because it's going to become scarce, at least on the consumer side, at least on the consumer cyclical, the consumer discretionary side, right? The Adidas or, the Foot Lockers, right? The retail apparel companies, those might struggle. And the reason they're going to struggle is because inventories are rising. Target is already slashing prices. What does this mean? This means that prices for other goods is going to start coming down because obviously other companies want to be cost competitive. They can't just have their high prices. So this is potentially going to bring down inflation already over the next 12 months. And with oil prices at all-time high, right? I literally filled up my car. I drive an Infiniti Q50, which is an all-wheel drive sedan. I literally filled it up not a few weeks ago, actually, just like 5 days ago, for $100 for a full tank. That was around 17 and a half gallons. Now, I obviously put premium in this thing because that's the only thing this thing is rated for. But that's a ridiculous amount of money I'm spending on gas. And I think 5 days ago was kind of the peak in oil prices, generally speaking. And so it really goes to show you that this inflation is being driven by oil prices. And although it's painful, we need to look at the light at the end of the tunnel and find the opportunities that are not affected by oil prices and not affected by food prices. Instead, we want to focus on those B2B businesses. Right now, the B2C, where consumer spending could drastically go down because of these oil prices. Instead, we want to focus on those B2B businesses that have good cash levels, that are selling to other businesses, because at the end of the day, enterprise spending is still at an all-time high. As you can see, we are not seeing a slowdown in the capital expenditure that businesses are doing, the growth that businesses are experiencing. Because in 2020 and 2021, a lot of these companies were able to raise a lot of money. And because of that, they're able to continue to expand their business. And even though their stocks are now starting to go down because we're obviously seeing a deleveraging over the past year or so, there's still intrinsic value in those stocks. And we cannot dismiss that. We can't just get demotivated when stock prices go down because in the short term, it's all irrational. But the fundamentals in the long term are what kind of matter. And so that's where I see the deals. And because of obviously inventories going up, we need to realize that's deflationary as well. And real estate is only now starting to inflect to the downside. And if real estate starts inflecting, that's when we could see the massive amount of demand destruction from consumers. And in turn, that's going to bring down inflation as well. And so the interest rates that we're already starting to see on the market, although they're not that high right now, we're already starting to see their effects. And it's going to take a couple of more months for this to really play out. But the good thing is that, at least for right now, the inflation expectations for the next 5 years are still relatively stable. This is something called the 5-year break even. As you can see, during the pandemic, inflation was obviously the last thing most people thought about. So we actually got almost a negative or a deflationary reading on this indicator. But the good thing is that ever since, ever since the end of March, we have seen a decline in inflation expectations for the next 5 years. People are saying that by 2025, 2026, we're going to be sitting at potentially a 3 or 3.5% inflation rate. Now, obviously, over the past couple of hours, this has gone up because CPI came out. But generally speaking, this is a good indicator of where inflation is going to go. And I think the people that are, manipulating or resulting in the supply and demand of this inflation rate are realizing the same things that I just talked about, which is that core PCE is still not as bad as people are expecting, even though obviously it beat analysts' expectations. And the fact that inventories are rising and that goods inflation is not as bad as services, oil, and food inflation right now. And overall, those are good for B2B businesses. And following that, the other thing that is a macroeconomic tailwind for the macroeconomic situation around the Fed being a little bit looser is the fact that the dollar is extremely strong against other currencies across the world, right? This is a good thing because the Fed has two main goals it tries to essentially accomplish through its policies. First thing is they want to make sure that the dollar is not getting devalued. And the second thing is that they want to make sure that pricing and employment is stable. They want unemployment to be record low and they want the dollar to be strong. And right now, from those points of views, we are actually doing very well. And so if the dollar continues its strength, which I think it will because the Eurozone is getting absolutely destroyed right now in fears of a recession, we could see the Fed be a little bit, less aggressive with raising rates, because the dollar going up means that there is more strength for U.S. goods, and even in a recessionary period, that is a good thing because that means that the recession might not be as aggressive, or we might get that soft landing that many people have been talking about. But obviously, we can't just look at the bull case. We also need to address what could be the worst case scenario. And I think the worst case scenario would be if we start seeing a wage price spiral, meaning that wage growth outpaces the growth of inflation, which would essentially lead us into a situation where the Fed will have to raise by almost 100 basis points in one of the meetings in the next 12 months. Right now, we're pricing in a 50 basis point for this month, one for next month, and then one for September. We don't know what's going to happen after September. It could be 25, 25, 25, or it could be 50, 50, 50. But clearly the Fed is data dependent. And if the data for August and June or July even comes in hotter than expected, then yes, we're going to get a 50 basis point hike all the way through the end of this year. And that is obviously going to be a little bit bad because that's going to result in a higher 10-year yield, which is obviously an expectation of where interest rates are going to be. And that's going to make it a little bit worse for the stock market. But again, macroeconomic tailwinds are starting to show a little bit, even though the data right now in the short term is still bad. And generally speaking, it's important to be a little bit more sensible of what can happen instead of what is happening right now. And so I continue to be a buyer. Let me know down in the comment section below what your guys' thoughts are on this inflation report. I know it's very tough because prices for everything are skyrocketing. But generally speaking, stocks in the B2B sector could perform better than some of those more consumer discretionary and consumer focused retail and apparel stocks like obviously Walmart, Target, and whatnot. But yeah, make sure to drop me a thumbs up if you found some value from this video. I am going to be posting a couple more edited videos over the next few weeks because I've already filmed those. But I think I'm going to stick with this style where I'm just kind of going at it on this data without really editing anything because it's going to take me a lot less time to film this and I can give you guys my instant reaction instead of waiting a few days. But yeah, I hope you guys have a great rest of your week and I'll catch you guys in the next one. Take care.